Welcome to this explainer. The stock market can feel totally overwhelming, right? We're constantly tracking endless tickers, stressing over daily fluctuations. It's incredibly easy to overcomplicate the whole thing. But today, we're going to simplify it using a concept we all already understand, building a house. Because if you have a simple, structured system, you can build a portfolio meant to be held forever, one that can weather pretty much any storm. So we're going to walk through this blueprint together layer by layer to show you exactly how a rock-solid resilient portfolio is constructed. Let's get into it.
Okay, let's dive right into this blueprint. We're going to build our financial house across 5 specific layers: the U.S. stock foundation, global market diversification, the dividend income layer, the cash safety net, and finally, the ultimate asset, you. Starting from the bottom, layer number 1, the U.S. stock foundation. This is our ground level.
You would never frame the walls of a house before you pour the concrete, right? Obviously not. Well, in the investing world, that concrete is a broad U.S. equity ETF. You really have two best options for this foundation. You've got the classic S&P 500, which gives you instant exposure to the 500 largest publicly traded companies in America, your Apples, your Amazons, your Microsofts. Or you could go with a total market fund like Vanguard's VTI. VTI actually goes a step further by capturing the entire U.S. stock market. We're talking around 3,500 companies. It includes those top 500, but throws mid-cap and small-cap companies into the mix too. Now, while their short-term performance might jump around a bit, historically over decades, both of these actually tend to converge around a 10% annualized return. So either one pours a rock-solid foundation for your financial house.
Let's move to layer 2 and see how this builds. Global market diversification. Time to frame the house.
So a lot of investors just stop at U.S. stocks and think, great, I'm perfectly diversified. But honestly, building a portfolio entirely out of U.S. companies is kind of like saying you've tried every type of food, but you've only ever eaten at restaurants within a 3-mile radius of your house. It completely ignores the rest of the world. To properly frame our house, we need a fund that truly represents the entire globe, like the Vanguard Total World Stock ETF, ticker symbol VT. Buying a fund like this means you're buying a tiny slice of roughly 9,000 companies across the world. And it naturally weights itself to about 60% U.S. companies and 40% international companies. It is quite literally the whole world captured in a single ticker symbol. And that 40% international slice, it's doing some serious heavy lifting. It spreads your money across both developed and emerging markets, places like Europe, Japan, Canada, Australia, and emerging Asian markets. And why does this matter? Because history tells us there's a vital strategic balance here. There have been long stretches, specifically the 1970s and the 2000s, where international markets significantly outpace the U.S. stock market. So when the U.S. is struggling, these international holdings step in as the load-bearing beams holding up your entire portfolio. And this brilliantly illustrates one of my absolute favorite things about modern investing: the cost. To own all 9,000 of those companies globally, the expense ratio is just 0.06%. That means it costs you a measly $6 for every $10,000 you have invested. And even better, the fund automatically rebalances itself. You literally never have to sit at your computer doing the math to figure out if you need to manually buy more European or Asian stocks. It just does the whole shebang for you. All right, layer 3, the dividend income layer. We are building the roof. Now that our foundation is poured and the walls are framed, it is time to build a roof that protects you, but also pays you just for living in the house. This is the income layer of our portfolio, which is beautifully represented by a dividend-focused ETF like SCHD. To ground this abstract idea in reality for a second, let's look at what's actually inside an ETF like this. You're buying a basket of high-quality U.S. companies with huge track records. We're talking household names: Texas Instruments, Qualcomm, Coca-Cola, Verizon. Now, are these flashy startups that are going to triple overnight? No, but that's exactly the point. They are recession-resilient stalwarts. They have consistently written checks to their shareholders through thick and thin, through pandemics, rate hikes, you name it. And those checks really add up. Right now, a typical current dividend yield for this fund is sitting right around 3.22%. To put that into perspective, if you had a $50,000 investment just sitting in this layer of your house, it would generate roughly $1,610 a year in pure dividends. That is actual cash landing in your account simply as a reward for holding the asset, no extra work required. But what should you actually do with that cash? You use DRIP, a Dividend Reinvestment Plan. This automatically takes those cash dividends and uses them to buy more shares of the ETF. So by reinvesting that income, you continuously buy more shares, which then produce even more dividends, and it dramatically accelerates your wealth compounding over time. It's like a snowball rolling down a hill. And just like our global fund, this dividend layer shares that incredibly low 0.06% expense ratio. Now, a quick aside, where you choose to build this financial house is absolutely crucial for today's retail investor. The platform matters.
Modern brokerages are now offering features that used to be locked away for Wall Street professionals. When you're picking a platform, look for must-haves like intraday margin parity, regardless of whether you have $5,000 or $50,000 in your account. Look for direct AI integration, so tools like ChatGPT or Claude can analyze your watch lists without you endlessly copying and pasting data. And honestly, institutional-grade charting and paper trading simulation modes are a must, so you can practice your strategy safely before you ever risk a dime of real money. Moving on to layer 4, the cash safety net. Every house needs a storm shelter. Unpredictable weather is guaranteed, right? This layer of your portfolio needs to be highly liquid and defensive so you don't panic sell those carefully chosen stocks when life inevitably throws you a curveball. So I have to ask, where is your emergency fund sitting right now? Seriously, think about it. Far too many people just leave their cash reserve sitting in a traditional checking account, earning a microscopic 0.01%, totally unaware of the invisible danger of lost purchasing power because of inflation. Or worse, they don't have a cash reserve at all. You are leaving real money on the table if your short-term cash isn't actively working for you. Just look at the stark contrast here. By utilizing a short-term Treasury bill ETF, specifically one holding ultra-short 0 to 3-month maturities, you could be seeing a 30-day yield of around 3.5% right now. Because these are backed by the US government and mature so quickly, they're considered about as close to a risk-free investment as you can possibly get, all while paying you a meaningful return to help maintain your purchasing power against inflation. So the crucial point here is what happens when tax season rolls around. Interest earned from U.S. Treasury securities is generally exempt from state and local income taxes. If you happen to live in a state with notoriously high income taxes like California, New York, or New Jersey, this exemption is a massive material advantage. It makes the effective after-tax yield on a T-bill ETF significantly better than a standard high-yield savings account that doesn't carry that specific tax perk. And that brings us to the final twist. Layer 5, the ultimate asset, you, the builder. We've poured the concrete, framed the walls, built the roof, dug the storm shelter, but this single most neglected layer of your entire portfolio isn't a ticker symbol at all. It's you, the builder. Reflecting on their own early days of investing, the creator of our source material shared this really profound realization. They noted that as an 18-year-old college student, they were essentially just gambling with their money. The core issue wasn't just that they picked bad individual stocks. The real danger was operating with zero system. They were throwing money at things they completely didn't understand. The structured ETF system we just built eliminates all that chaos, freeing up your mental energy to focus on what actually moves the needle in your life. And all that freed up energy, that should go toward investing in yourself. The creator shared this wild anecdote. Back in 2010, they graduated into one of the worst job markets in recent history and ended up selling cars instead of becoming a financial planner. Years later, they finally decided to scratch that itch. They bought a giant whiteboard off Craigslist, strapped it to the roof of a Subaru Outback in the freezing Cleveland October weather, literally got frostbite carrying it into their house, and started a finance channel with an old camera. They didn't make a single penny for a year and a half, but by consistently grinding to create their own niche, it eventually became their full-time career. The takeaway here is just profound. Yes, absolutely, financial ETFs are vital because they protect your purchasing power and allow your money to compound in the background. But investing in your own skills, your passions, and your human capital, that is what actually multiplies your earning potential. You've got to find that creative outlet or that professional itch and scratch it, especially if you aren't fulfilled by your current 9-to-5. Wow, we've covered a lot of ground today, going from broad market foundations and global diversification all the way to dividend income, defensive cash, and ultimately to your own personal potential. You now possess the exact simple blueprint for a lifelong 5-layer portfolio. But the final, most important question remains. You have the plans for the house, but are you ready to invest in the builder? Think about what your own Craigslist whiteboard might be and take that first step today. Thanks so much for joining us on this explainer, and we will see you next time.